Asymmetric bets appear when there are frightened or leveraged sellers who are forced sellers. So let me give you an example which happened in our life. Post Ketan Parrot scam, Unit 64, UTI went into a trouble. They had to sell their portfolio. So there was a company they used to own called Burroughs Welcome. I still remember they used to make around only 40 crore kind of a profit. They had some 100 acres land in Bandu. No new products were coming to Burroughs. They were all going to Glaxo. But Burroughs had some very great products. Higher dividend per share, higher return on capital employed than Glaxo. And more importantly, the range of possible outcome was very narrow. I specifically remember even till date, it had 205 rupees per share as cash in its books, given out to Government of India, Reliance, and all AAA rated parties. And UTI was selling the stock at 180 rupees, 160 rupees, 150 rupees. And this was a company which was constantly profitable and growing. Can you guess what was my concentration in Burroughs Welcome?
I don't know, 10% maybe?
80% Burroughs Welcome, 20% cash. We made a multi-bagger in just a matter of 18 months.
Welcome to Markets Ki Baat by Groww. I'm Anupam Gupta, and today on this episode, my guest is Kuntal Shah of Oaklane Capital. Kuntal, welcome to the show. Thank you so much for doing this for our audience.
Pleasure is mine.
Kuntal, as both a veteran value investor who relies on deep old school fundamental research, right, and a tech co-founder who also builds data filtering tool, you sit at a very unique intersection, old school, tech. Looking at it from my perspective, or rather as our audience perspective, as a retail investor who's drowning in thousands of pages of annual reports, industry data, what is one really effective high leverage way that they can integrate AI into their workflow today to slash the information processing time, right? Without, or rather, while maintaining the critical thinking and not outsourcing that also to AI.
Fantastic. So, just think of this mental model where there's a Ferrari, right? Now, if this Ferrari is given to me, it is of some value X. But imagine that Ferrari is given to Lewis Hamilton or Michael Schumacher. It can be something very non-linear, right? So AI is such a tool that it's a Lego brickish model. It's constantly evolving. It is getting better every day as we speak. And it is capable of doing some amazing things. And in fact, I would go out on limb to say that retail investors are going to be one of the biggest beneficiaries of the AI boom because it can help them in multiple ways. But they should also understand the limitations. So while it is a great tool where you can narrow your search process very dramatically, imagine as an investor you have to process multiple documents, annual report, transcripts, broker reports. They are all scattered information, unbundled, trapped in various devices, various apps. You could all integrate, and you could write an AI agent who can bring certain portion from A document, certain portion from B document, and create a very holistic, stitched up picture, which would have taken you days to into in few minutes. So it's a like a great enabler. Coming to the caution part, obviously it's an evolving technology. If you had asked me this question 2 years back, it used to hallucinate a lot with PDFs, blah blah blah. It would make up numbers. Things are just improving, but there are few boundary conditions. If you do yourself, outcomes are non-linear. So first is with any AI ML project, data cleaning is the hardest part. So don't just dump documents tree. You got to give it access to meaningful data in a format which it is finding easier and cost effective to understand. Otherwise, two things will happen. It will miss a lot of good portions, or it will hallucinate, or your token cost or cost of implementing AI will just balloon through. Because if you put like a 600-page annual report and the compute cost just balloons up literally. So it's not a capability issue, it's also an economic constraint issue also. So typically we'll end up giving, if it's a structured data, we give it in an XML format and all machine readable format. So it becomes easier, it becomes more efficient, it hallucinates less, and it becomes more cost effective. So first is data cleaning part. Secondly is, though the process is improving because compute chips are getting better and faster, memory is getting upgraded, context engineering is happening. But what we have found, at least for us, is, if you create a curated document which controls what we, in our language, we call binder, where, we run, on local desktop machine, Python script, which extracts a lot of stuff, marks it down in a readable markdown language or HTML language and create what is known as a wiki LLM. It is kind of a master skill document which which gives the 80% of the heavy lifting. And that really improves the output thoroughly, rather than just dumping 80, 90 documents of various vintage, various year frame, and various source documents. Thirdly, I think some amount of fine tuning is required, where you should ask the LLM to make sure they've understood your context. So your prompting should make sure that machine model, whichever you're using, has understood your language, and you correct it before the processing starts. And the last I find very personally usable is, devil's advocate. We have subscriptions to 4 or 5 large language model. We play one against each other. We try them to contradict each other, find faults. So this is what Perplexity is designed as council of LLM. So you play one against other. Actually, you try to find out the flaws, and that reveals the both sides of the story. And then obviously the human judgment and justification and years of experience takes over.
Okay. Moving to the sourcing funnel, you stated that your initial screening process is pure science, using hard metrics like capital efficiency, liquidity, growth. Using them, you eliminate, maybe 97% of the investment universe. You walk us through the exact quantitative boundaries that a company must cross to make it to that 3% opportunity set.
So Anupam, there are 4,000 listed companies plus. It keeps increasing. We are a very concentrated investors. We don't have too many products, single product, monoline business. We need 20 good ideas. So we have to eliminate 0.005% of the entire opportunity set. The reason is not hard to understand, because a small team can only process so many companies and their competitors and their past. There's a physical constraint on the amount of information we can handle, and especially with each company we have to see the entire value chain and the competition. So there's only a finite set of companies which can address. So elimination works like a beauty contest. You have to ruthlessly eliminate. Obviously, in the process, you will miss some gems, but that is a feature. It's not a bug. As long as you get your fishing pond where there is a decent type of your kind of companies available, you should be fine. The idea is not to optimize and make it perfect. The idea is to just reduce the information load and go deep. You can only go wide or you can go deep. We choose to go deep. So that's the first starting point. Also, fortunately, since we are not managing open-ended redeemable capital, and we have a longer patient capital, we are not bound by narrow bucketing that I'm a growth investor or I'm a value investor or I'm so and so, which people have to do to sell the product, right? It's more a marketing constructor, because institutional investors or distributors would want to put you in a category and allocate money accordingly. We are go anywhere fund. We are not bounded by any such. So we're in multiple screens. So threshold for each of these screens will be widely different. A value screen will have a multiple different threshold. A growth screen will have a different threshold. A mean reversion theme would have different threshold. Mispricing screen would have a very different threshold. So thresholds are very different. But I can give you few things. Elimination works on top down, where you eliminate fragility. Whatever looks fragile to you, what is outside your time bound, what is outside your competence, so you just eliminate. So stress promoter, leverage, multiple parameters you decide which aligns to your screening process, and you eliminate what you rightly said, 97% of the opportunities, and maybe even more. So that's a top down elimination. Once you have a funnel decided, then the job is to then really look at the qualitative overlay on top of that. And there the tools tend to get more widely dispersed, in the sense you'll have to go by the promoters, capital allocation, treatment of minority shareholders, addressable market size, the runway, and so on and so forth. So the science part ends at that 97, 98%. The judgmental part, the hard part, takes over from there. And investing is more a liberal art. We were just talking about liberal education priorities code. It's it's a last liberal art.
Liberal art.
So that's where the judgment takes over, and you have to then decide how your portfolio constructs play out.
Sure. Multiple expansion, right? In a bull market, high valuations are justified by narratives of structural shifts. It's always a structural shift. From your observation of market cycles, how do investors mistakenly conflate this a simple liquidity-driven multiple expansion with actual earnings compounding?
So let me quote a cliche that rising tide lifts all the boats, right? So interest rates are the force of gravity on the two things: the business cost of funding and borrowing, and the risk-free rate of return, and the spread on top of that, and also the discount rate, right? The future cash flow, how much you discount at. So if you see globally, there is a liquidity onslaught since 1980. If you see track just M2 money supply, it perfectly correlates to the index. The growth in M2 money supply has been fueling the asset price bubble. So, in my opinion, depending upon the geography, depending upon the sector, or depending on the company, at least 40, 50, 60% of the returns you have made has come outside growth in dividend or growth in the earnings portfolio of the company, and this can reverse when the cycle reverse. I was never a fan of a macro investing and all these things, but 2008 taught me otherwise, that macros do matter. The liquidity and the cost of liquidity being the two most important driver of the understanding, because everything is cyclical. There's a business cycle, there is a fiscal cycle, there's a monetary cycle, and there's a competitive cycle playing out in the sector. So combination of, so if you really look at the stock market is story of cycles and human behavior with the cycle. So interest rates have been a huge part of it, and continues to be so.
And in fact, talking about that, you've said that rising interest rate environments act like gravity on market valuations, right? Keep them grounded, keep them float. So when rates stay elevated, or as the phrase goes, higher for longer, how do you adjust your valuation models? Does it fundamentally alter the type of businesses that make it past your filtering process?
Yeah, definitely. So let me give you an example. Uh, Higher interest rates also accompany mostly higher inflation, because if inflation was benign and stagflation very rarely happens, but normally both go hand in hand. So first of all, it impacts the kind of businesses capability to borrow, right? The borrowing rates go through the roof, which impacts your cash flow to the residual shareholders like us, which is equity, the last man standing in the cap table. Obviously, also when the inflation is high, your depreciation understates the replacement cost, right? Your cement plant or the machinery, whatever you have provided depreciation, when you try to replace it, normally the depreciation doesn't provide for the true economic replacement. So it's a double whammy for the company itself, the businesses which you are investing in it. So that's on the business side. On the valuation side, obviously, the very obvious correlation is the discount rate goes up. The rate with which you discount the future cash flows to arrive at the present value goes through the roof. But people don't realize that even the duration of the kind of companies you see it shrinks. So in a bull market, you might be more liberal to tolerate a company having a very deferred operating cash flow, incur losses in interim, gain market share. Those kind of a behavior normally happens in loose monetary. If you see the last bubble happened in .com, then in 2000, always loose monetary policy and low interest rates make investor more accommodative and stretch their time horizon of when they expect the company to start delivering the tangible operating cash flows. But when the interest rates go up, there is a big alternative which comes up, which is safe and which acts as a force of gravity. So you are more careful of making sure your companies deliver during a narrower time frame. So opportunity set definitely changes. It shrinks, and sometimes high growth companies which experience trouble, or companies which are burning, burn baby burn kind of a philosophy, the anti VCP model of land grab, they can react very violently during those price of rising interest rate environment. So the landscape changes, Anupam. It's and you have to react to it.
You have to react to it, right? Time corrections. You noted that extremes on the upsides, right, rarely end in a swift price crash. Instead, they resolve themselves through agonizingly really long periods of time correction, as it's called. Probably something that we are seeing now. So for a long-term compounder, how draining psychologically is a 3 to 5 year time correction on yourself, and how do you manage that stagnation in your portfolio?
So Anupam, I have some actually contra evidence to this. Uh, if you see the analysis of asset prices prior to creation of central banking system, and even when the gold was a currency, the the frequency of the accidents, recession or correction, used to be less. But they would last long, sometimes a decade. But with the monetary phenomena of counter, liquidity, the so-called Bernanke put, and never fight the Fed kind of a situation, they try to correct the asset prices by interfering in the market mechanism. So basically, what has happened is the frequency has become much larger. The recessions and the accidents happen much farther, and the amplitude has gone up. So this has bearing on that old school conventional of the time correction to play out. In fact, coming back to Indian context, when I joined the market in '92, that post social meta scam, between '94 to '99, 2000, index went nowhere. Many people left the market. You would come to the market, your company would deliver the returns. It will the stock price will not go where, nothing to do. It was a psychologically draining than the flash crash and bounce back in response to. So you look COVID. Most of the people didn't even register. If you had just gone to sleep for 3-4 months, you would not have recognized. Same thing. So actually, swift corrections normally have also underlying reason which you can explain, which you can internalize, which you can be corrected by the forces in the market. But time correction which are extended are very psychologically draining because of three things. First of all, there's a real opportunity cost, right? The time is flying by, your portfolio is not compounding, and you are wondering why. Then there's a social cost, right? While your portfolio may not be doing well, but somebody investing in some other asset class or some other geography would be happy and doing it. There's a kind of something, okay, oh, what am I missing? It's functionally equivalent to the other lane, the cars are whizzing by and you are stuck in a slow moving lane. So which is a hard social cost. And the third is most important, I feel, and that's why I referred, a lot of people left market during that period. Self-doubt. You start questioning whether you are on the right track or whether you are outdated, whether the market is a different mode. So I think that the psychological cost is far more damaging compared to a swift crash and a bounce back by the monetary response, liquidity response, which we see. If you see now the crises are 2 years, 1 year, half an year, 3 years. 3 years it's if you hold back, if you went in 1970s or 1930s and 40s and all, the crises used to last a decade and so on. So
Much
one
longer.
has to keep this
Yeah.
logarithmic scale of time in mind.
In mind. Okay. Bizarre valuation. You've got this very interesting presentation on the art of selling where you list bizarre valuation as a core reason to exit. Now, how do you distinguish, right, between a stock that is simply fully valued versus one that has entered the zone of irrational exuberance where obviously the risk reward is not worth it?
Let me give you across multiple dimensions. So, in our mental construct, there are 4 zones of valuation. One is definitely undervalued, in which case it's a buy. Then there's a fairly valued, in which case it's hold. We have learned not to sell because as the companies deliver and the scale up happens, it attracts institutional sponsorships whose expected rate of return is much lower than yours and mine are, but they determine the price. So valuation might look dear compared to your internal benchmarks, but for somebody expecting, you might be expecting 16% return and the institution might be expecting 6. So they can obviously outbid the same asset price, right? So you need to, those are fairly valued, but you don't sell just because they are fairly valued. Then there is overvalued, where definitely the mode and construct should be trimming, right? And then the last is the bizarre. And give you some examples of bizarre. Let me start with a country. So Japan in 1980s, late 1980s. It became, the real estate boom became so bizarre that the Imperial Palace Garden was valued more than the California state. And California state is the 6th largest GDP in the world. Now this you could immediately say it's a bizarre, right? It's a bizarre when you just compare. Same thing, say Nifty 50. In 1970s, the US banks,
The US Nifty 50 of that time.
US. The only documented history is abroad, unfortunately, where a lot of things have happened. Ours is not documented. But I'll keep coming back to ours also. 1970s, the banks were allowed to sell wealth products to their retail customers. Previously, they were banned. So they started pushing all these blue chips, Johnson and Johnson and Merck, and all the blue chips. Their PE multiples reached to 90, 91, 92, and for next 15 years they just derated and became a single digit PE. So that is, even in .com, if you see the percentage of software market cap as a percentage of total market cap of India and the world just shot up. Let's give you a specific Wipro. I vividly remember Wipro had a very low liquidity because of the high promoter holding. If my numbers are more or less correct, in 2000 the profit was around $140 million at that point of time, but market cap had almost become $20 billion, which was 4% of India's GDP. Now you could definitely say this is bizarre. So while bizarre might look clear in retrospect, you could just still, if you do cross asset, cross yield, cross comparison, even bizarreness would be visible at that point of time. And that time, I think so the right strategy not only to sell your shares but to sell your neighbors and borrowed shares also and sell short.
Okay, second theme for this episode, reverse DCF and expectations investing, right? Now, we know, sell side analysts spend hours building forward looking Excel sheets, project a target price. You advocate reverse DCF, which I guess, so for our audience, if you could just demystify how reversing the maths helps, and it helps you catch what the market is dangerously implying about a company's future growth.
So Anupam, say if you are in a VC or a PE industry, the assets are not liquid and you don't have a secondary market pricing of it. And probably DCF is one of the way to go about it, or there are other ways of option value or comparable metrics and so on and so forth with some discounts applied. Fortunately, when we are talking of listed market, there's a wisdom of crowd which is telling us what is the price of the business today and the price of all the liability and debt they have on the books. So enterprise value is discovered by the market. Right or wrong, it's a very liquid view of the market of that moment of time, right? So there's no need to actually do the DCF to arrive at the fair value. It's actually much more better to understand what the market is embedding in terms of future growth of the company and then compare it with the base rate and the probability of that happening. So let me understand that at 5-6 years back we did valuation of Hindustan Lever. It was like coming out to be, it was implying like 22 to 24% growth rate of cash flows for 10 years. Now, Hindustan Lever is a very well entrenched, deeply penetrated portfolio of company products, and unless parent allows domestic company to come out with some new earth-shattering product category to have double the nominal GDP growth rates, sounded very possible because the margins are perfect, their asset turns are perfect. There's not much levers to play around with, product mix, geography mix, penetration, blah. Only thing that could have given them growth is a new volume or new price, new categories. And what is the probability of that happening? So then you could draw your own conclusion. In short, reverse DCF is exactly opposite of DCF. DCF is a figment writing tool, if I can go out on a limbo to sell, because your inputs can give you a crazy output prices. If you work backwards, it makes you an interrogative tool. It makes you to question where the embedded expectations, under what condition will they come out to be true. So from a dreamer, it makes you an interrogator, and for an investing perspective, that's the best frame of mind to be in.
I mean, you practically answered my next question because I was going to, in fact, ask you that, if the price says that you're going to, your numbers only, you need 24% growth for the next, 10, 15 years. How do you use that insight? At what point do those baked in expectations make a stock an absolute sell or an avoid?
So, Anupam, when you decompose DCF, you will have to have a view on volume. You will have to have a view on margin. You will have to have a view on product mix. You will have to have a view on geography mix. You will have to have all these views baked into the price. Now, when a company is priced for like what you say 25-30% kind of growth for long period of time, couple of decades, basically you are saying that this company has to deliver 99 percentile growth and margin combo to deliver the cash flows, And the management quality and pedigree should be such that execution is also flawless, 99%. Now, when you do a joint probability of all these ends together, volume and product mix and pricing mix and execution and all, the probability just diminishes materially, where it becomes a base rate companion care. What is the probability? This is a rare bird you are talking of. It's like a black swan, real black swan. So then it makes you consider, and that's why the reverse DCF is a interrogative tool to make you introspect rather than to dream about what it can be. It forces you to ask a difficult question: okay, under what circumstances
Can this be possible? Yeah. Michael Morrison, he talks extensively about expectations investing, Kuntal, and it's an idea that you closely align with. So, how do you map a company's current regulatory or competitive landscape against the expectations that are embedded in the stock price to find maybe some execution mismatches?
So let's look at a typical analyst. What does he do? First, he will study the landscape, regulatory regime, demand drivers. Then he will see company. Then he will see the numbers, reinvestment rate, cash flow, growth, and then arrive at a value. Right? That's a standard analyst way. In expectation investing, which is also a functionally equivalent of reverse DCF, it actually starts with reverse. The process just gets inverted. That under what condition of this regulatory regime or in competitive environment or market structure can company deliver these numbers? So it exactly inverts the whole question to the head. So it forces you to look at market structure. Most of the analysts don't don't land up thinking a lot about competitive intensity and market structure and value migration. Let me give you an example. The biggest profit pool and one of the biggest high growth industry India has witnessed in our lifetime has been telecom industry.
Okay.
1996 or 7 we
When
launched.
mobile
Mobile was launched, 64 rupees outgoing, 32 rupees
incoming.
incoming minute. There were some 27, 28 telecom operators all making fist of money. Spice Telecom, Hutchison Telecom, whoever could get regulatory license from regulator. It was a land grab, right?
Yeah.
It was a classical landscape grab.
Yeah.
Look at the fast forward. It is the most penetrated product in India. Everybody has a mobile phone. Everybody has a subscription. Everybody has a data. One of the highest consumer of data. But look at that today. There are 3.5 players. Actually 4.5 players. BSNL, which is losing money. We have Vodafone, which is losing money and depending on the shareholders, largest to survive, including government. Geo scale, but very poor profitability metrics and cash flow. The only real guy who's really is Bharti Airtel. So in a sector which has seen lips and bound growth of revenue pool, you have had a very inverted outcomes because of sheer competitiveness at work. How do you model this? Most of the analysts don't model this. So the market structure, dynamics, value migration are not talked about in mostly analysts tends to stop at 2 or 3 years. If you are in 26, hypothesis is at 29 and there is some multiple assigned to it. But if you really look at it, Anupam, the largest value is terminal value. 70 to 80% of the company's value is back-ended. And as an analyst, there are two problems. As long as you are watching it, microscope is fine. But if you start using telescope, a 1 degree tilt, you are looking at a different galaxy. And that's what happens all the time.
Yeah. And in fact, talking of linear extrapolation, right? Because that's one of the most common investor fallacies. You just extrapolate a company's recent high growth or peak margins into forever. How do you train yourself in a booming sector, when you're looking at a booming sector and identifying where the structural peak ends and the inevitable, fall or mean reversion begins?
Unfortunately, this doesn't get announced with a ring of bell or a dhol tamasha. I think so. The best predictor, especially in the stock prices, would be to monitor the terms of trade of the businesses. See, as an investor, we are far removed from the ground reality of the business operation. But the market in which the business is operating is very perceptive of increased supply or weakening bargaining position So this manifests itself in an adverse loss of market share or adverse terms of trade, where you have to give a longer credit period. Your receivables go up, your inventories go up, your payables are suddenly raw material suppliers are asking you for spot delivery like they are doing right now. If you want to buy plastic, you have to give the advance. So I think that the two most metric one can look at is market share and value migration, and second is the terms of the trade, how the business environment is deteriorating for the company at B2B level or B2C level. In B2C level, it's very easier to monitor the reviews, the ratings, the social media captures a lot of it. But at B2B level, just the receivables, the terms of the trade are one early early lead indicator of an weakening competitive position. I would say. I wouldn't say red flag. Sometimes it's temporary because companies can use that to gain the market share. It's always a trade-off. In a week time, market shares are very permanent. Once get taken, they are very hard to give up. So sometimes companies choose to sacrifice margins and extend credit to gain the market share. But if you're seeing a company is not gaining market share and yet the credit cycle is the DSOs and all those are rising, then it's a big call.
Let's go deeper into that, na Kuntal, because so you assume you look at a case where a business experiences a really significant boost in profitability, right? How do you differentiate between it being this boost being because of a permanent expansion in margins or just a temporary cyclical tailwind that will just aggressively revert to the mean in a while? Long term, short term, structural, cyclical.
Structural reminds me of this time is different, which is rarely the so. So, see, there are certain industries where margins are good by default. Like, let me give you an example. Say Nestle, right? Look at all Nestle product. Maggie, they buy atta in per kg. They sell you in per packet. Effectively, they are selling you atta at 65,000-70,000 rupees a kg, where the cost is a fraction of it. There's a unit conversion, there's a metric, there's a branding, there's a IP. You are not cribbing. If somebody told you are buying atta at 75,000 rupees a kg, you would struggle, but effectively that's you are doing. Or for that, look at the chocolate. You can manufacture chocolate at home, but look at the pricing. So anything you put in mouth, branding, the consistency, the promise of the brand, the promise of the delivery, the economies of scale, global sourcing. So those companies tend to, you can give a very high probability of maintaining the gross and EBITDA margin. The sales growth could flounder, their ability to reinvest the capital and introduce the growth might flounder. Short stock price may remain stagnant. All those things are a separate question. But as far as business is concerned, one could give them a benefit of a permanently high structural margin because of some branding, some IP, some network effect, some
moat or whatever,
which gives it a very price competitive positioning in the marketplace and the consumer mind space. But look at any companies like a specialty chemical or something. You can add as many adjectives, super specialty, niche, whatever you want to call. Input is in kg, output is in kg. The guy at the buying end, if China is supplying at X dollar, is not going to pay you even 5% premium on top of that. So there's a bound. And then those gross margin and EBITDA margins are highly volatile. So then applying all these superlative adjectives. In fact, Michael Mauboussin has only given this interesting study that 80 to 90% of high growth structural transformation rated by analysts give up all that tags in 5 years. It don't even last beyond the 5 years.
80 to 90% in 5 years.
What analysts saw as a structural high growth stories, compounding, this time is different. Gives up it tags because of but rightly so, because of the in a competitive economy, your high margins are somebody's entry pool. So you are seeing here in India today, be it wedding wear or be it paints, being it in cake, in wires, the competition is ruthless. It's brutal, and to assume permanent high growth rates. In fact,
it's not.
In our team, we constantly please note that the reversion to mean is the most powerful thing. Sales growth is mean reverting. There are very few companies, a tiny company can grow for long, but at a decent market share and scale, it's impossible. Margins are mean reverting, and so are valuations.
Okay. So accounting red flags. You want that listening to numbers is an art, right? And that aggressive accounting policy typically creeps in at the peak of the cycle, probably where promoters are more adventurous at that point of time. When sales growth begins to slow down, right? What line items in the balance sheet or in the cash flow do you look to catch management's trying to artificially sustain this illusion of growth?
It's just not the line item. Let me this thing. Even the condition and covenants surrounding the business. Is he in the breach of some debt covenant? Does he want to raise the money? Because this
These things
the
happen at that time.
incentives
Yeah.
when there are capital considerations also.
Yeah.
I've written extensively about accounting and spoken so, and I won't bore you with that. But the key thing to again watch out is a single promoter can do it, but entire industry won't do it. So once you have a view of an industry across time, across its peers, you get to spot such kind of behavior very easily.
Yeah.
You can, in a Hindi, you can ask, iski khameed, meri khameed se safed
Safed
kyun? So what is that secret sauce of this thing? So once you dig deeper and things get out, and I told you, it starts manifesting in receivables. It starts manifesting in aggressive capitalization. See, accounting is very simple if you have fundamental view. What is the need at the other side of the table? To increase the income and the profits. So obviously cost has to be understated,
Yeah.
right?
Correct.
How do you understand? One is you defer, one you capitalize, so and so forth. On the balance sheet side, same thing. You want liabilities to be lower. So obviously assets should be overstated.
Yeah.
Once all these basic frameworks are very clear, and if you see them across geography, the same businesses model,
Yeah.
you see them across time, and you see across the peers, it's easy to murder the body, but very hard to dispose of the body when
Parts.
you triangulate in such manners.
Yeah. Okay. Moving from prediction to preparation, and to quote Howard Marks, you can't predict, but you can prepare. So as an investor operating in an inherently uncertain world, how do you transition your mindset away from making macro predictions towards thinking strictly in terms of probability distributions?
So prediction usually revolves around a one-central tendency, right? I have a view. Okay, this will happen. At the most, I will have to sound logical, I will add a bear case and a bull case to it. So I will have a base case probability, bull case probability, bear case probability. But life doesn't just revolve around that. We have a four-layered analysis framework where first is a range of outcomes. Even low probability outcomes are to be considered. So given this business context, given the industry structure, given the competitive structure and regulatory landscape, what is the range of all possible outcomes? You don't discount any other as a low probability event. You just note down all the range of outcomes. Then you assign a probability to it. Now, some of them will be a low probability events. COVID was once in 100-year kind of a event. World War is twice in a century kind of a event. Recessions used to be, over decades. Corrections are happening every 3-4 years. So you go by the probability and the frequency with which it's likely to impact.
Sure.
And the last is the impact.
Okay.
Certain events have very low probability but very high impact. And those are to be avoided.
Okay.
Those are to be avoided because they kill you.
Yeah.
Now, let me translate this abstract concept into how do you actually do it. So, I don't understand pharma business that well. Some colleagues used to do. But we were looking at a company called Disclosure. This is not a recommendation. Anyway, we have sold the stock. But just this is educational material we are talking about. Sun Pharma Advanced Research.
Okay.
Now, this is a company which is spun off from the generic business of Sun Pharma, which is into innovator, new drug chemical entities. Innovation business are costly and the failure rates are very high. Now, look at it. It was working on multiple molecules. Each molecule could fall off at any stage. There are 4-5 stages of approval. Even if it succeeds, a competitor could come out with a better strategy, which is more effective, less side effects, so on and so forth. So when you aggregate the probabilities of all things, the range of outcomes was so wide.
Yeah.
that it was very difficult to put even small percentage of money into it. It became a pass
Wow.
for me, because it's just a range of outcomes, sheer range of outcomes
Hmm.
for me
Hmm.
to predict, and put something in become too hard.
Okay.
So Spark became an idea which looked exciting.
Mm.
You have a very credible promoter and a very credible business story out there, but become too hard for us to analyze, and what you can't appreciate, you can't
Yeah.
invest in. So this is how the entire framework plays out. It's just not a single monolithic or by view. Okay, it's a much more holistic view of what
Sure.
can happen, and so on and so forth.
Yeah.
I hope this is.
It is. In fact, my next question is going to probably go one level deeper into that, right? What does a true asymmetric bet look like in Kuntal Shah's playbook? How do you look for situations where the downside is capped or quantifiable, and upside possesses a massive unpriced optionality?
Let me give you the conclusion first, and then I'll give you the answer also. I think so. Asymmetric bets appear when there are frightened or leveraged sellers who are forced sellers.
Okay.
They have no other option but to sell, either because of leverage or being shut down or something. So let me give you an example which happened in our life. Post Ketan Parekh scam, Unit 64 UTI went into a trouble. They had to sell their portfolio. So there was a company they used to own called Burroughs Wellcome. This was a 51% subsidiary of Glaxo.
The pharma company, Burroughs Wellcome, subsidiary of Glaxo.
So Glaxo and Burroughs Wellcome Trust in UK had merged, and globally it was a unified company. But India, they were listed as two separate companies. Glaxo being the big daddy, more liquid, high PE multiple, institutional favorite, high discounting, and very liquid name. While Burroughs I still remember, it used to make around only 40 crore kind of a profit. They had some 100 acres land in Bandu. No new products were coming to Burroughs. They were all going to Glaxo. But Burroughs had some very great products, Calpol and so on and so forth, and higher dividend per share,
Yeah.
higher return on capital employed
Yeah.
than Glaxo. And more importantly, in Glaxo, the parent had 48%, while in Burroughs they had 51%. So parent interests were aligned to yours.
Yeah.
Only reason this company was not merged because there was a labor court case going on. We went to Thana, we talked to the guys. It was some piddly case of 22 lakh rupees, but which been multinational out of its legal consideration was fighting out. We knew this case was going to be disposed of, and even if it loses, amounts are not earth-shattering, nothing is going to happen. The range of possible outcome was very narrow.
Oh, okay.
Now, I specifically remember even till date, it had 205 rupees per share as cash in its books,
Wow.
given out to Government of India, Reliance, and all AAA rated parties. And UTI was selling the stock at 180 rupees, 160 rupees, 150 rupees. And this was a company which was constantly profitable and growing.
Yeah. Everything's right.
Everything is right. The stars were aligned. What was the downside? There was no downside.
Yeah.
So this is what I meant then narrowing out a downside. So this typically happens when there are panic sellers or leverage sellers. It happened in 2008. It happened in 2020.
Yeah.
When the panic grips over and there are forced selling, these are the kind of inefficiencies you witness, and that's a classical example of a very asymmetric bet. There's nothing you could have gone wrong if you are acquiring a company at 180 rupees when it has 205 rupees cash, which is verifiable, and 40 crore cash flow every year. And you know what? Luck favors the bold.
Always.
In 18 months, the court case got disposed of. The merger happened. We got 1.8 shares of Glaxo to 1 share of Burroughs. Burroughs was trading at 180. Glaxo was trading at 800. And we got 1.8 share of Glaxo for the merger.
Almost at par. I mean, for 1.2 is to 1. No, I'm saying the exchange, for something that has such a big price difference.
We made a multi-bagger in just matter of 18 months. And again, one more, things get better. Nimuslide, which was a competing drug, got banned. The sales also went up, and the earnings also went up. So when you have paid a very defensive price, good things tend to happen. And that's what asymmetric bet. That your downside is very known and very limited, finite, very knowable, very narrow. While the upside can be anything, which is the case.
So you're a strong proponent of using mental lattice work that includes mathematics and decision trees. So when new disconfirming evidence emerges about a portfolio company, how do you apply Bayesian analysis to update your initial thesis, right, without falling trap to commitment bias?
Yeah, so commitment bias does funny things to us, Anupam. Once we have spent a lot of time analyzing the situation and a decision has been made and a check has been written, we start to own those ideas. They become ours.
Yeah.
But in investing, ideas are meant to be stress tested. They are not to be meant to be cherished. So the rule is you have to seek out the disconfirming evidence. People only talk to the people. So typically for us, it boils out to is if we like a company, we stop reading all the good reports about the company. We only read what is bad. We seek out disconfirming evidence. And the right step, in my view, is to what Munger calls inversion. You do pre-mortem. You assume, okay, 5 years, 10 years down the line, which is our investment horizon, this company is down 50, 60%.
And
And
then
what is it would have cost it?
You work back towards.
What is it would have cost? You just write down on the journal where you can think of anything, promoter exit, management doing something bad, capital, you write down. Now, you may still execute the idea, but at least you have now created a metric framework of what will you monitor when your hypothesis starts deteriorating.
Yeah.
And the last thing is you need to then have a trigger also ready. Okay, at this threshold, I'll be a ruthless seller. Then I won't wait and try to justify and work backwards and try to defend my hypothesis. So this having this 10th man, the concept which is there, and this inversion, you do a pre-mortem which forces you to think. Okay, what are the things you will look for which will negate your hypothesis?
Okay.
This thinking is a more preventive measure. And as they say, prevention is always better than cure.
So, okay. Last part of the episode, Kuntal. Philosophy of concentration, right? There's this fierce debate between the school of diversification and school of extreme concentration. Given the present, the ever-present risk of ruin or tail events, unforeseen tail events, what is your personal philosophy on portfolio concentration? How much allocation is too much for a single stock, no matter how high your conviction is?
Let me go back to Burroughs Wellcome. Can you guess what was my concentration in Burroughs Wellcome?
Oh, should be pretty high because you've made a multi-bagger, so I don't know, 10% maybe?
80% Burroughs Wellcome, 20% cash.
That was your portfolio. 80-20.
There are concentration is a dual-edged sword. Very risky. I wouldn't advise it for many of the retail investors or non-professional investors because there are multiple elements. First, look at psychology. You can practice art of concentration if only you have patient capital which is non-callable.
You don't need it. Non-callable at all. Yeah.
Inflow also should be under your control and outflow should be under your control. If neither inflow or outflow is under control, and if you try practice the art of concentration, you will be massacred. So stability of capital, which is aligned to allow you to finish, is very important. Secondly, stability of your own mindset. If you give up at the worst point of time, the concentration will have a big blow on your compounding efforts. Third, ability to have the conviction. Many people have insights. Many smart analysts out there, they have phenomenal insights. But the problem is the conviction to hold them through the journey. Volatility and time squeezes out people at the worst time. Anupam, let me go out on limb to say, the role of the stock market is to exploit your weakness. And your weakness can come from instability of your capital, instability of temperament, instability of your insight, or instability of your conviction in the idea. So market can exploit all those things. So concentration is a very psychologically damaging than anything else. It's more a behavioral attribute rather than the scientific attribute part of it. Because on paper, I can clearly justify a concentrated portfolio because if you see the research, if you have 16 to 80 non-correlated ideas in your portfolio, you are adequately diversified.
16 to 18 non-correlated ideas.
The most important word is non-correlated.
Non-correlated, obviously.
If you have 6 real estate companies, it's not 6 position, it's one single position in a interest rate sensitive and housing. So it has to be non-correlated. Different customer, different pricing point, different needs. Totally variance. Business are cheese and chalk. But if you see today the institutional side of the story, there are wide number of products with large number of overlaps and huge diversification. So at some point of time, investor has to, based on one's capability to do deep work, one's stability of mindset and patient, take a call. That do you want to create a curated museum of Picassos and Hussains, or do you want to create a warehouse where all kind of things are represented? And diversification is easiest to do, and that's what most people end up doing it. But let me tell you one thing, Kevin. If you ask Kuntal of today, that 80-20 would be 20-80.
The Kuntal of today.
Kuntal of today would be a 20-80. I was naive. I was bold. I had nothing to lose at that point of time. And I was very young. I was foolhardy. If you ask the same situation represented to me again, I wouldn't exceed 15-20% of the position. So as you mature, as your capital base compounds, as you have to lose more, you tend to be less risky.
Okay. The satellite strategy framework, you've previously mentioned an interesting architecture, right? Combining high position sizing with your highest conviction ideas at the top of the portfolio with a series of, as you said, smaller non-correlated ideas at the bottom, non-correlated. How does this structural framework help soften the lumpiness of returns while protecting you from permanent capital loss?
Well, Anupam, this is not my framework. It's a borrowed framework. Multiple other people have written about it. NZS and Vanguard and a lot of people have written research papers. It's a borrowed concept, truth be told. But
fair point, disclosures.
But I align to it.
Yeah.
So as an investor, there are two fears. One is fear of losing money, right? Now that is being addressed by having core, stable, mature compounders, which are of size, which are of certain liquidity, which have not too much variation in their business outcomes. They are not binary bets. They are more predictable, narrow range outcomes, more consistent, mature companies, longevity, all the things you look in a blue chip, management which is proven, market share, leadership position, all those checklists distributed. That allows you to sleep well at night. There's other fear. Fear of losing opportunities. The one that got away. The VC thing. You can't afford to let go of the outlier thing. So the 80% portfolio, which is concentrated in 8-10 ideas, 7-8 ideas, allows you to sleep well at night because they are more stable business, and that gives you a comfort to see that our life is not going to change. Psychologically, we are not going to be damaged. The remaining 10-12 position, which is 1-2%, which constitute 20% of the portfolio, is more an optionality portfolio, where you hope some of them will migrate to become core by delivering the outcomes you want. But at the same time, the downside of the portfolio level is capped. Okay? Even if you lose half of those companies, it's a 1 year of compounding you lose and you can bounce back. So it doesn't destabilize your operation and freeze you out of it. So basically it dampens the volatility of your mind more than anything else. This construct or barbell construct, this is bread and butter and this is your icing on the cake. It's a combination of these two, and the position sizing is the real maths behind it.
Okay. Going back to the nature of managed capital, right? Because you've spoken about how the choice to concentrate heavily depends or diversify depends on the nature of the capital you manage. You said uncallable. So how does managing this kind of capital, permanent, patient, unlevered, allow you to look at portfolio concentration very differently? Say from a, very typical hyperactive fund manager who's facing monthly redemption pressures.
We only mentioned redemption, which is outflow. Inflow is also equally bad.
In this environment.
Imagine the markets are booming. You are not finding value, but every day there's an inflow coming in. SIP money is coming, the retail money is coming, institutional money is coming. And you have to deploy it because the mandate is constructed in such a way that the asset allocation decisions are taken by somebody else and deployment decisions are taken else, which is the case in a lot of the listed peers, which are, is a very tough task to manage a revolving door capital, which is both inflow is not at the time you want and the outflow is also not at the time you want. Both tends to make your life infinitely difficult. There's a mathematics. If you have only 2 factors, outcome are 4. But when you have 3 factors, the outcome are 9. Right? 3 into 3. No, actually it's 3 into 3 into 327. It's not just this thing. So complexity of investing just goes through the roof with each additional variable which is kicking in. So when you have a permanent and a stable capital, which you can afford to take illiquidity risk. You can afford to take a concentration risk. Marry it with cash call, which allows you to average down or trim up. Those kind of flexibility, a typical fund manager who's managing revolving door capital doesn't enjoy. So the same talented fund manager managing these 2 different capital will behave very differently and will construct portfolio very differently. The whole portfolio construct changes. It's a different animal. That one change in factor leads to a dramatically downstream implications.
Okay. Last 2 questions, Kuntal. Top down versus bottom up, right? Top down sectors versus bottom up stocks, stock picking. When looking at this remaining 3% of your investable universe, do you approach it with sector first, top down, macro, looking for tailwinds and then finding the best execution vehicle? Or are you like pure bottom up stock picker, focus entirely on microdynamics of the individual business, irrespective of which sector it's in?
So we tend to invest bottoms up, but we tend to worry top down. Let me explain this to you. When you look at the portfolio or the opportunity set from a top down view, it forces you to look at the industry structure, the right sector, the right time, the right tailwinds. But it excludes right management, right company, so on and so forth, right? So it's an incomplete part, right? You can get that this theme is right, robotics is going to take off, robotics is cheap, the $16,000 you get a good robot, it charges in 2 hours, it can do so many jobs, ROI is justified, labor, you can have a very detailed top-down view, but it doesn't give you, the bottom is what which gives you which company and which management. Because let me give you an example, which is one of the best wealth creator in India IT industry. Mastech started earlier than Infosys. The promoters of Mastech were equally well qualified. If you had seen in 94, from top down, you could have just picked Mastech and missed Infosys. So bottoms up is an essential part of a top down. Top down helps you to pick the right sector, right themes, right timing, tailwinds. But bottom is where you have to add on to the particular business, the management pedigree and the particular competitive, because the value is constantly migration. I'll give you another example. Say you are bullish on the transportation theme, aviation transportation. Obvious would be airline. But then look below the surface, you could see a ground handling company, you could see an airport retailing company, you could see a airport catering company, an airport lounge company, some of whom might have a lower competitive dynamics and lesser dependence on leverage balance sheet or foreign exchange outgo and so on and so forth. So you got to just understand the lay of the land, understand the value chain, and take so value chain resides at both top down and bottom down, and that's how.
Okay, the last question, Kuntal, the pre-mortem filter, right? Not post-mortem, but pre-mortem. So once a stock ticks all your qualitative and quantitative boxes, you advocate for performing a pre-mortem rather than a post-mortem. So before pulling the buy trigger, how do you conduct this pre-mortem to simulate how this investment could completely fail over the next 5 years? You mentioned this before also.
So one thing I didn't mention is always good to have good mentors and good colleagues with whom you can discuss your ideas and find your faults. See, it's very hard to find fault in one's own work, but sometimes it's visible to the others. So one thing which I do, apart from being, the pre-mortem and the 10th man, we seek out this 10th man. So these 10th men are our mentors who are very capable, accomplished people in their own right. They have no interest in our business because they are choosing their own businesses to follow. But they've seen the patterns, they've seen what doesn't work, they've seen what can go wrong, and they can give you an insight. Oh, please be mindful of this. This can hurt you, and those. So that having that relationship network, which is pattern recognition, can just assist to your, the all the things which I said regarding inversion, regarding pre-mortem, and regarding the 10th man concept.
Very interesting. And with that, that is a wrap on this episode of Markets Ki Baat with Groww. My guest, Kuntal Shah of Oaklane. Kuntal, thank you so much for doing this for our audience.
Thank you. Pleasure was all mine, Anupam.
Thank you so much.